Good evening. This is Ken Long from Tortoise Capital. It's August 18th, Monday night, and we'll take a quick look at the market health check. I want to highlight for your attention the comments we made on the weekend. We said that the market is digesting its last run, and it's been sideways for a week with 102 shaping up as resistance, with 99 as the first support and 95th as the second support. So that's really what we're talking about in this green and blue blocks here. And you can see 102, the resistance, and 99 was first support level. Today we had a volatility event that was so strong that it has triggered the overreaction system. So that's an extraordinary volatile move. And it's already broken the 99 support. 95 is the next support level, and that's this red line right here. We can see that ATR percentage, or the ATR, the measure volatility, is hooked up sharply here in the little red square as a result of that extraordinary gap down. We're below the 20-day moving average. We're still between the 20 and the 50, and that's why I think 95 is the next psychologically important level. There's really no technical reason for the market to find support in this area. There's a good probability this will be seen as a buy-on dip for technical traders because this last bullish move has left us 13% above the 200-day moving average, clearly in bull territory. And we can see on the Williams percent R10 that we've dipped down into minus 95, which is well below the threshold of minus 80, which indicates a oversold condition. That would routinely be an entry in our channeling system, which fired for all indices this evening, as did the index overreaction system. I want to show this idea here, that from about July 13th, the last time the market was in oversold condition, up until today, when it is actually, let's go the day before today, when it entered its oversold condition. Back at this time, ADX was below 20, and a day or two later, after this bounce off the bottom, is when the plus DI crossed the minus DI, and then you saw the strong bullish move. Plus DI was positive the whole way, and then ADX, the measure of trendiness, crept up from below 20 all the way up to 35, 37-ish, and then it started to roll over. It's, as we've said a couple times last week, it's hard for the market to sustain its trendiness over 35 for such a long period. In fact, the previous long bull terminated back here in late June, and it had only gotten as high as about 25, as you can see. So this move up to 35 was really quite an extraordinary move. MACD histogram has dipped under the zero line for the first time since, well, back in June, and so we were just beginning to enter the winter season, and so if this little pullback is seen as a buy on dip, then we'll see it correct pretty quickly. But if this is more of a pullback, what we might think about is the space between these two vertical blue lines as the last bullish move, and it went from about 88 to 101, and so that's a 13-point move. So even if we look at the halfway pullback on that, that gets us right in about 94. So if we just looked at that as a 50% retracement of this last bullish move, you can see that the green line would be considered fair value. And so that's my sense of this 95-ish area is an important resistance point. If it can hold above 94 or above 95, then that's going to be a sign of buy-on-dip opportunity. The real question is there some kind of follow-through tomorrow? Two scenarios. One, big gap down, and market makers are buying inventory, and we see a morning hook and reversal with strength. That will be a good time to get on double-leveraged ETFs on an intraday basis with technology leading the way. If we see gap down and fail, then that's a good time to get long the double inverse ETFs like EEV or FXP for inverse China, or even QID for inverse technology. So that's the view from 10,000 feet with the market health check. Thanks for your attention.